When people hear about rising tensions in the Middle East, the first thoughts are usually about politics, security, and global stability. But there is another side to these events that rarely gets discussed outside of financial circles. Wars and geopolitical conflicts have historically moved markets in powerful ways. Sometimes they create panic. Sometimes they create opportunity. And often they do both at the same time. If a major conflict were to break out in the Middle East, the effects would likely be felt far beyond the region itself. Global markets are deeply interconnected, and the Middle East sits at the center of one of the most important resources in the world: oil. That alone means any serious conflict could ripple through energy markets, inflation, stock prices, and even interest rates. To understand what a war in the Middle East could mean for your investments, we need to look at how markets have reacted to similar situations in the past. Historically, one of the first and most immediate reactions during Middle East conflicts is a spike in oil prices. The region produces roughly a third of the world's oil supply. Countries like Saudi Arabia, Iraq, Iran, and the United Arab Emirates play a central role in keeping global energy markets stable. When conflict threatens production or transportation routes, investors quickly price in the risk of supply disruptions. One of the most critical choke points is the Strait of Hormuz. Nearly 20% of the world's oil passes through this narrow shipping route every day. If tensions escalate to the point where shipping is disrupted, oil prices could surge very quickly. In past crises, oil has jumped 20, 30, or even 50% in relatively short periods of time. When oil prices rise sharply, it tends to push inflation higher across the global economy. Energy costs affect transportation, manufacturing, food production, and nearly every major industry. Higher oil prices mean companies spend more on operations, and those costs are often passed on to consumers. For investors, that creates a chain reaction. Higher inflation often forces central banks to maintain or raise interest rates. Higher rates make borrowing more expensive, which can slow down economic growth and put pressure on certain parts of the stock market. However, not all sectors react the same way. Energy companies are often some of the biggest winners during oil shocks. When oil prices rise, companies involved in oil production, drilling, and refining can see their revenues increase dramatically. Major oil producers, pipeline companies, and energy ETFs historically perform well during periods of energy supply disruptions. Defense companies are another sector that tends to benefit from geopolitical conflicts. Governments typically increase military spending during periods of global tension. Companies that produce aircraft, missiles, defense systems, and military technology often see increased demand when conflicts escalate. On the other hand, some sectors can struggle in these environments. Airlines, transportation companies, and industries heavily dependent on fuel costs may face rising expenses and tighter profit margins. Consumer discretionary sectors can also weaken if higher energy prices reduce consumer spending power. Another important factor during global conflicts is investor psychology. Markets do not only respond to economic fundamentals, they also react to uncertainty. When uncertainty rises, investors tend to move their money toward assets that are considered safer. This is why gold often rises during periods of geopolitical tension. Gold has historically been viewed as a store of value during times of instability. When investors become nervous about currencies, markets, or global conflict, demand for gold can increase significantly. Government bonds, particularly U.S. Treasury bonds, also tend to attract investors seeking safety. Even though bonds may not always offer the highest returns, they are often perceived as more stable during uncertain times. But it is important to understand that markets rarely move in a straight line during conflicts. The initial reaction is often volatility. Stocks may drop sharply in the first days or weeks after major geopolitical events. News headlines, political decisions, and military developments can cause markets to swing rapidly. However, history shows that markets often recover faster than many people expect. Looking back at previous conflicts, including the Gulf War and other Middle East crises, stock markets frequently stabilized within months once investors gained clarity about the scale of the conflict. This creates an interesting dynamic for long-term investors. While short-term volatility can be intense, many investors who panic and sell during these periods end up locking in losses. Meanwhile, disciplined investors who stay focused on long-term fundamentals often benefit from the eventual recovery. Another area worth watching during a Middle East conflict is the U.S. dollar. In times of global uncertainty, the dollar often strengthens because it is seen as a global reserve currency and a safe place for capital. A stronger dollar can impact international investments, emerging markets, and commodity prices. Technology stocks may also react differently depending on the broader economic environment. If higher energy prices lead to higher interest rates, growth stocks that rely heavily on future earnings projections can come under pressure. On the other hand, if the conflict remains contained and economic growth continues, technology companies may recover quickly. For everyday investors, the most important lesson is that geopolitical events are unpredictable, but market patterns during crises are often surprisingly consistent. Energy tends to rise, safe haven assets gain attention. Volatility increases across the board. But perhaps the biggest mistake investors make during global crises is reacting emotionally to headlines. Financial media thrives on urgency and fear. During conflicts, headlines can make it feel like markets are on the brink of collapse. Yet historically, the global economy has proven remarkably resilient. Wars, political crises, and economic shocks have happened many times before, and markets have continued to grow over the long term. That does not mean risks should be ignored. Diversification becomes especially important during uncertain times. Investors who spread their investments across different sectors, asset classes, and geographic regions tend to weather geopolitical shocks better than those who are heavily concentrated in one area. Some investors also choose to allocate small portions of their portfolios to assets that historically perform well during crises, such as commodities or precious metals. While these assets may not outperform during stable economic periods, they can provide a form of protection during extreme events. The key takeaway is that a potential war in the Middle East would almost certainly create volatility in global markets. Oil prices could spike, inflation pressures could increase. Certain sectors may surge while others struggle, But volatility does not automatically mean disaster for investors. In many cases, these periods simply remind investors of something markets have always done. React quickly to fear, then gradually return to fundamentals. Understanding how different assets behave during geopolitical crises can help investors stay calm when headlines become dramatic. Instead of reacting impulsively, investors who understand these patterns can position themselves more intelligently. Because in the end, the biggest advantage in investing is not predicting every event in the world. It is staying rational while everyone else is reacting emotionally. And during times of global uncertainty, that discipline can make